Good morning and welcome to Coffee with Connie. I'm Connie Fuchsa with Foot Title Group, where we protect your home ownership. And often I come in, I try to do 2 times a week and come in and talk to you guys about things that are happening with real estate or things you may or may not know about real estate. I am not a real estate agent. I am not a mortgage lender. I am a title company owner, and I've owned my title company for a little more than 30 years. And so I've had lots of different experiences. So I get all kinds of questions all the time, and I decided to start doing live broadcasts to try to answer some of those questions, because if you have that question, I'm sure someone else does as well. And that way I can try to help you understand some of the things that we see and some of the experiences that we have, so that you don't have problems or questions that you don't get answered. So I love it when you guys submit questions, message me about things, because it helps me understand maybe some topics that I'm not talking about that you want to know about. So I do have a lot of different things that I prepare to talk about, but if I get a question from someone, that means there's something going on in the market that maybe someone else might want to know. And on the heels of that, if I talk about something that you find very interesting, please share it. Just hit the share button, because there's a lot of people out there that I can't get to that you know that may have similar questions. And so I'd love to be able to connect with those people as well. So please hit that share button. And the other thing is, we try to go between 8 and 8:30 on Tuesdays and Thursdays, but sometimes you may not get the information or know that we're going live. So if you hit the follow button, that'll make sure you don't ever miss one of our broadcasts. So thanks so much for tuning in. Hey there, Miss Lisa. How are you this morning? Good to see you. So today I wanted to talk about this question that seems to come up a lot, and maybe not quite as much as it was maybe a year or 2 years ago, but it happens because the economy that has changed so much over the past 10 years has really affected sellers and how they're able to sell their homes and some of the things that they need to do to go through it. And a lot of times we talk about buying homes and what those nuances are, but today we wanted to talk about a little bit about some of the things that sellers are dealing with, because these are some problems that ultimately affect buying and selling real estate depending on which side of the table you're on. And so helping to understand what those pieces are will help you understand, whether you're buying or you're selling, how some of this actually works. So hey there, Tony. Good morning. How are you? Tell Tammy I said hi too. Good to see you guys, and I feel like it's been forever since we've actually talked. So good to see you guys. Thanks so much for tuning in. So let's say, and this actually came up, as I said, when people ask me questions, then I try to talk about that information. And so earlier this week, someone did message me and ask me exactly that question. So if I have a piece of property that I own and I want to sell it, what happens if I owe more to the mortgage company than the home is actually worth? And so there's a couple of different things that can happen. Before the economy crash and the real estate crash and all of those things that happened, what traditionally would happen was, if the seller borrowed more, or the owner of the property borrowed more than the value of the property, and they weren't able to pay it down before they went to sell it, they would have to come to the closing table with cash to pay up what that balance was. So let's say, for example, how does that happen? So let's say, for example, sometimes if you are borrowing money on a VA loan, the VA loan may require you not to put any money down on that home. And let's say that the values change a little bit, down a little bit. Now, not a crash amount or that type of thing. Or let's just say that the values stayed the same and you got orders that you had to move very early on in your ownership, 1, 2, maybe 3 years, and didn't give that house very much time to appreciate, because it doesn't appreciate very quickly. So for that reason, you may end up trying to sell that home. And even though the home is worth maybe a little bit more than you owe, by the time you pay all of the closing costs and the real estate agent professionals that you need to help you sell that home, you're probably going to be a little bit in a deficit. Those are some funds that you're going to have to bring to that closing table to settle up that balance that's going to be owed on that property. So let's talk about another scenario. Let's say that you've owned your home for a long time and you built up some equity in that home, and you wanted to pull some money out of that home, maybe to pay for a child's college, maybe to pay for buy a boat, maybe to buy another vehicle. Maybe you wanted to do some financing that way, and you borrowed, usually if you do a refinance, to borrow some money and take out of your property, or if you do a home equity line to borrow some of that equity to be able to pay for some other things, then that is recorded against your property, and it's a secured loan against that property. And then the values change a little bit on that property, then you, again, would be in a situation where you owed a little bit more than you could actually sell your home for, or you may be close and you would have to pay the closing costs again and pay for the professional to help you sell that property the way that it needs to be sold. And so those are some costs that you'd need to bring to the table. So those closing costs that you would actually have to pay in cash. So, hey, Brenda, how are you? Good morning, Ann. Good morning, Anita. How are you? Hey, Holly. Good to see you. Thank you guys all for tuning in. So it doesn't always necessarily have to do with the real estate market dropping a lot. What it could be is that you don't have enough time to build back up that equity between when you took out that additional financing or when you borrowed that money to when you're going to be selling that property to cover the additional cost that you're going to need to sell that property. So that may be some of it. Now, let's talk about if you borrowed the full value of the property or a lot of it, and then the housing prices really reduced like they did over the past 10 years. Up until very recently, that was a real problem and happened all the time. So then you've got a seller who needs to sell their home for some reason, medical reason, personal reason, financial hardship, or if they were military and being transferred, being deployed, they needed to sell the property, or if you're in a position where your job, maybe your company moved to another state, was closing its office in this area, moved to another state, and offered you the opportunity to move. That is a good reason to be able to sell your home, to want to move, because you want to go where your job opportunity is. Good morning, Melissa. Hey there, Miss Karen. How are you? Thank you guys for tuning in. So all of these reasons, really valid, good reasons to need to sell your home, even though you're in a situation where your equity is not increased. So let's talk about how did that happen when as the real estate economy or the real estate market was changing and housing prices were dropping because they inflated so incredibly out of what the norm is. They eventually started dropping, and what happened is people were borrowing money based on those higher values. So let's say, for example, you bought a house for $500,000 and 4 years before it was $350,000. So when you bought that house at that high end, you borrowed $450,000 or $480,000 to buy that house. And then as the real estate market collapsed, what happened was that value collapsed as well. And now you're in a situation where a house you bought a year ago, 2 years ago, 3 years ago is now only worth, it was worth $500,000. Now it's only worth $350,000. Before that big rise in the real estate market. And so unfortunately you owe $450, but that house is only worth $350. You've got a big deficit there. And who has $100,000 sitting in their bank account to pay back a mortgage? Most of us don't. So there was a lot of things that happened, some legislation that made some programs available for people that were staying in their homes. There's, various different types of loans that you could refinance the mortgage to get down the amount and to get down the rate. Because a lot of these people who that value dropped could also not refinance their homes. So they had interest rates that were 5, 6, 7%, and the interest rates started dropping down to 2, 3, 4%, and they couldn't refinance because the value of their home was not there. Hey there, Pam. How are you this morning? Hey, Cecilia. Good to see you. So now you're talking not only about being a seller trying to sell your house, but you're also talking about an owner trying to refinance your house. Again, this value is causing a problem because you can't refinance it. A lender's not going to loan you money on something that you owe more than it's actually worth. They're not going to loan you more than the value of the item they're loaning against. So there was some government programs that came out that changed some of those rulings and allowed some people to be able to refinance those homes and those mortgages to get those interest rates down and get those payments down, even though they owed more than what the value was worth. But we're talking now about if you're selling your home, what happens when you're selling your home and you owe that additional $100,000? Can you afford to come to the closing table with $100,000? Probably not. If you could, you probably would have borrowed a lot less when you originally purchased that house. So there's a scenario, a process that a lot of lenders decided to get involved in, and it's called short selling. And what this means is the lender will agree to take less than what is owed on that mortgage to pay that mortgage off and release it from the property and release you from the responsibility. There's a lot of things that go into it. So in order to start that ball rolling, you need to start it like when you're getting ready to put your house on the market. And because you have a lot of paperwork that you have to complete, and some lenders only allow you to do it when you're in a financial hardship situation. So if you decide to move to another area just because you want to move and you want to sell that house, more than likely they're not going to consider it. If you want to move for a job change, they may or may not consider it. If you've been up to date on all of your mortgage payments and you have some of these other events happening, they may not consider it because you haven't displayed a financial hardship. It's a catch-22. None of us want to end up having a credit issue showing up on our credit for not making a mortgage payment, but some lenders were not allowing people to do this without being behind in some of their payments. Kind of stinks. Some of the rules changed as it was evolving because it was a whole new phenomenon that a lot of lenders were dealing with through this process. But some of the things to think about and to get you, if you're in this situation, to start thinking about and start talking about. Because if you are in a situation that you may think you want to sell this property and you know you owe more than what it's worth, you need to start having these conversations with the mortgage lender that you make the payments to. Because there's paperwork they're going to require that you provide. And then they're sort of driving the bus in control of what offer you take when someone wants to make an offer on the property. If somebody wants to buy your home, they sort of drive that bus. They drive the bus about how much closing is going to be paid and some of these agreements that are done through the contract process when somebody wants to buy that home. So you definitely need to start this conversation with that mortgage company well in advance of putting your house on the market because you want to make sure you understand all the pieces and the things they need. The other thing that'll go into play with this is as I talk about all the time, dealing with professionals that have these experiences. You're dealing with a real estate agent that is a professional that's been in the business for a while and has a lot of experience with these types of processes. They can navigate a lot of these things for you, and they can help you put together the paperwork that the lender is going to require in order to make sure the process goes a little bit smoother. They're also going to help you navigate when a contract is provided to you by a potential buyer to make sure that it meets all the pieces that your mortgage company is going to require. So, and then when we go to closing, your mortgage company is also somewhat driving the bus, even though you're signing the paperwork, when they want to see all of the numbers, all of the closing documentation that you're going to be signing, because they want to make sure that everything they expect to happen, they're taking a huge loss, and they want to make sure that everything they expect to happen in order to take that loss is falling into place the way they expected. So really good conversations to have in advance with your mortgage lender. Owing more than you actually can sell the home for or that the house is worth is not a dead end. There's a lot of opportunities there, but you just have to have some conversations and make sure that you understand what the rules are and what you need to do to take care of it. Hey there, Lisa. Thank you. I appreciate that. Good morning, Michelle. How are you this morning? Thank you guys all so much for tuning in. I really appreciate your time. I know it takes a lot out of your day when you're in the morning trying to get ready and get things going. And I do appreciate the information, the feedback. And as I've said to you many times, please, please, please submit questions, information. When you think we're talking about something that's great, please share it, because hopefully when we talk about something that you find valuable, somebody else you know will find it valuable as well. Couple things I did want to share. There is some information on our website for buyers and sellers and realtors and lenders that are resources with a lot of this information on it that we talk about. There is also links to a lot of different places that can answer a lot of questions for you. And we put out a new piece of content every month, and it's on our homepage, and there's a bubble that says what's new. You can click on it. Right now, this month, we're talking about the 10 most frequently asked questions about home closings. That's on there. You can click on that and download it. And if you have a question about closing costs on our website, there's a free calculator. You just go on, and if you put your information in, you can save the quote, and then you can actually go back and make changes to it. So it helps you understand a little bit about some of the closing costs. How about when a street address doesn't match the tax record? Interesting. First, let me say, before I answer that, I meant to say this at the very beginning. I know a lot of people follow me from across the country. And a lot of times when I talk about things, most of the things we talk about are the same across the country. this is one of those topics. This is something that no matter where you're located, this information is valuable to you. If we're going to talk about something that's specific to Maryland and Virginia where we're licensed to do closings, I will point that out at the very beginning of a conversation. So I just wanted to let you guys know that if somebody's watching me from Colorado or from New Mexico or Texas, all of that information that we talked about today is valid, and most of the things we talk about is information that can help you. Cecilia, your question is a totally different question, but very good, and thank you. I appreciate it. In answer to your question, you're going to need to go to the tax office. It's the state in Maryland. It's the State Department of Assessments and Taxation. There's an office of that in every county in the state, and you have to talk to them about why it's listed that way. Many times we've had to go in and make adjustments with them, providing documentation and showing them why things are listed incorrectly in the tax record. It may have been the way something was presented when it went to closing and went to be recorded. It may be a document that was submitted that they misinterpreted. It could be a lot of different nuances that could make that happen. But the first stop would be in Maryland, which I think you're probably asking about, would be going to the SDAT office or the State Department of Assessments and Taxation office in that county where that property is located, and sit down and have a conversation, because they can help you. And more than likely, it's something that needs to be amended. It's just going to take a couple of extra steps. And we can help you navigate that. If you want to reach out to somebody on our team in the Maryland office, they certainly can help you navigate that as well. So hopefully that helped you too. And just like Cecilia, please ask questions. If you run into something that just doesn't make sense, please let me know, and we will do our best to try to help you get the answer, or answer it for you, or direct you in the right direction. So thanks so much for your time. If you're watching us from Virginia and you happen to be thinking about moving to, or have just moved to, the King George or the Westmoreland area, we are having an event May 6th from 10 to noon at the King George YMCA. It's called Make Yourself at Home. We will have all the vendors that are there are service providers in that community. They are none of them are paid for-profit service providers. That we have the fire department, we have the police department, we have social services, we have Parks and Recs, we have the Animal Rescue League, we have the Boy Scouts, the Girl Scouts. They're all going to be there to answer questions. Bring your children. We will have snacks and water, and the play area in the YMCA will be open. You can get tours of the YMCA. It's a great community resource, and we'll be able to there to answer questions about home closings and real estate and mortgages. And if you're in the real estate profession, feel free to come by and talk to people, meander around. I think we have about 15 vendors that are going to be there. They're going to be doing self-defense classes and all different other kinds of cool things. So please, if you're new to that community or thinking about moving there, or you just want to check it out, come on by May 6th from 10 to noon at the King George YMCA. Hope you guys are having an awesome day. I look forward to talking to you again soon. I'm Connie Fuchsa with Foot Title Group, where we protect your home ownership, and you have the right to choose who does your home closing. So think that through, do a little research, make some calls, and choose wisely, because it makes sure that it impacts your home ownership after closing. Hope you guys have a great day. I'll talk to you soon. Bye-bye.